Hey everyone, in this video we're going to have a look at Netflix and more specifically the future prospects of Netflix. So the reason why I'm reading up on this company right now is because the company actually reported its Q4 earnings last Thursday on the 20th of January, and while the numbers for the past quarter came in pretty well in terms of earnings and revenue, the prospects of subscriber growth in the future was actually well below expectations. So I was reading this article here by one of the analysts at Simply Wall Street, and basically it was explaining how the report went and some of the highlights from it, and talks a bit more about the subscriber growth. So I wanted to have a look at the future prospects and see just how much that's actually impacted investors' sentiment around the stock. Because as you can see, it was a $225 billion company, and it lost about $45 billion. Like, it dropped 20% in a day, which was just a crazy sell-off. So let's just see how much that's kind of impacted the underlying expectations of the future in terms of revenue and earnings, and see if that actually presents any sort of interesting opportunities. So having a look at the future growth section here, we can see that it actually passes 4 of the 6 metrics that Simply Wall Street checks. So it seems like it's got some pretty good future prospects. Of the 39 analysts that cover the stock, it has about 17% earnings growth expectations from them. And that's like the consensus, right? So some expect higher earnings growth, some expect lower earnings growth, but that's like the average. And so having a look at this earnings and revenue growth forecast chart here, you can see that it's pretty much a continuation of the trend going up and to the right for both earnings and revenue. These numbers have been updated since analysts have now released more of their up-to-date sort of expectations. So prior to the report, prior to the most recent earnings report, I believe some of them have higher earnings growth expectations. But now, since the company has released softer expectations for subscriber growth, like I believe it expects to have 2.5 million subscribers added in the first quarter, compared to the first quarter last year when there was 3.98 million subscribers added. So slowing growth in the subscriber growth base. And before this latest result came out, these growth forecasts were a bit higher because analysts obviously didn't expect the company to announce that its growth was going to be that slow. So there seems to be a bit of a flattening off here, whereas before I believe there's a bit more of a up and to the right trend. But still, having a look at all the fundamentals, it's unfortunate that it actually seems to have reported negative free cash flow again for the last quarter. So that's a bit of a shame. But having a look at this though, the 70% earnings growth is pretty decent, and to try and get some more context on that, what we're going to do in this next section is compare it to the industry and market, see how that compares. So here's that section here, the analyst forecast for future growth, and this is comparing the company to the industry and the market that it's in. So you can see here that Netflix has 17% earnings growth for the next couple of years per year, whereas the industry, being the entertainment industry, it's expected to have earnings growth of like 25% per year. Now that's pretty solid, right? That's much higher, and on a compounded annual basis, that does make a big difference in the long run. Compared to the US market, though, it's actually outperforming. So 70% versus 13%, okay, it's got a couple of percentage points higher, and again, over the longer term, that does make a big difference. So as I compare the company to the market, I would be happy to pay a higher multiple for Netflix, considering it's expected to have higher earnings growth. But if I compare the company being Netflix to the industry, I would actually expect it to trade at a lower PE multiple, right? Because it's actually not expected to experience as much earnings growth. And so if I was to look at the valuation section and I have a look at the PE ratio, it's trading roughly in line with the market, right? So it's actually a bit more expensive, 34 times earnings versus 32 for the US entertainment industry. So it's like I need to make the decision, do I feel that like paying 34 times earnings for 17% growth is worth it? Or do I feel like there's better opportunities out there? So with this kind of information in mind, I could be like, okay, I'm going to go to the screener and I'm going to filter for companies in the entertainment industry that have earnings growth over 17% and see if I can find any better sort of opportunities where it's like a company's trading at a lower multiple than 34 but has higher earnings growth than 17%, because that's kind of the insight here, right? Like there may be better opportunities out there than what I'm seeing here at Netflix. But again, if I think there's sort of competitive advantages or moats to Netflix, like it's say there's a stickiness to a subscriber base, like they hang around with the business and they're not typically they don't leave too quickly. All those kind of aspects have to come into play in terms of when I'm trying to interpret and analyze whether like the current price to earnings multiple or the earnings growth expectations are fair, right? If I'm paying a fair price for that kind of growth. Now, if I look at the annual revenue growth, it all seems to be much more contained in a much more similar bracket, right? So 11% earnings growth per year for Netflix compared to 13% for the industry. So still higher, but not too much higher. And then 9.1% for the market. So all pretty similar in terms of sales growth, but underlying earnings growth is where there seems to be big discrepancies. And so I'll go and see if there's any better opportunities than what I'm looking at right now. In terms of the metrics that Netflix is passing, though, we can see it's passing or 3 of the 5 here. So it is earning above the savings rate, which is like a bare minimum. So it's great to see that's well above the bare minimum, being 17%. It's growing faster than the market, again, which we mentioned is great to see. But the earnings growth isn't huge, right? Like 17% per year is good, but it's not above 20%. So it's good, but not huge. Revenue versus the market. So again, Netflix's revenue is expected to grow faster than the market, and that's great to see, right? It's one of the higher growth opportunities out there, but it's not the highest growth, right? So we can see here that it's like, yes, 11% is good, but it's not. It's like not higher than 20% per year, which would be like a high growth stock. So that's something that they need to keep in mind about like the future prospects of growth are moderate, but they're not like huge. Next section I have a look at here is the earnings per share growth forecast. Now this just gives me an idea of like basically the range of analyst estimates, and then it can help me get my own context about the stock, right? So here we can see the blue line is the previous earnings per share, like what it's actually reported, and the blue shaded area is what analyst expectations were. So it actually has surpassed analyst estimates in these last couple of years, or last year I should say. But going forward, this teal blue line is the analyst average expectations, right, for earnings per share, and the teal shaded area is the range of analyst estimates, right? So the most optimistic to the least optimistic, and that's everyone in between. So having a look at this, it seems like the consensus is that earnings will actually decline. For the most part, earnings will either be flat or decline slightly over the next year from 2022 to 2023. But then it seems like the consensus pretty much agrees that from 2023 onwards, there's going to be some growth in the earnings per share. And now what my process would be here is I'm going to go and look at the underlying business, right? I'm going to go look at the subscriber base. I'm going to go look at what their growth plans are. Like, do they plan on expanding into new markets? Do they plan on increasing their prices? Do they have a sticky customer base that wouldn't care about price increases like inelastic? Is there a whole bunch of other aspects that can help influence the company's underlying earnings, right? What are they working on? So as I go off and do all that research and I try and build my narrative and build my thesis around the stock, and I get an understanding of like what the growth prospects of this company is or are, and then my interpretation of those growth prospects, I'll then come back here, right? And I'll try and get an understanding of what I actually think is likely, and what I think would be like a fair estimate for the company's earnings per share. So let's say, for example, I look at all those aspects of the business and I go, oh wow, I actually think like, yep, they're going to do price increases, they're going to expand into more markets, they're going to improve their operating margins from like, I think it's 19 to 20% now to like, let's say low 20%. That would have a big impact on the stock. Let's say I think those forecasts are likely to happen, and so as a result, I'm very bullish on the underlying earnings growth, and I think earnings per share could actually be in the top range here, right, or even higher if I have a reason to believe so. So I see that it's like the top analyst expects, or the analyst who's most optimistic expects earnings per share to be like $22.60 by the end of 2024, and so I may think, yeah, I agree with that, and if that's the case, I actually expect earnings growth to be really quite high over the next couple of years, right? And so if I'm looking at that earnings growth and I think that's likely, and I look at the current price of 34 times earnings, the PE ratio, I'm like, yeah, that's actually a really good price to pay, because I think earnings per share or earnings growth is going to be higher than like 17% per year. I think it's going to be really high. Then I might think today is a really good valuation. Alternatively, if I look at all those same prospects, like the ability to increase prices, and I think, now they're going to lose some subscribers from that, or I look at their expansion to new markets and I think their expansion isn't going to be that profitable, like it'll be quite an expensive process, and I look at like a few other factors and I think, no, I'm actually not too optimistic on the company's earnings growth. I think it's not going to be that high. I think it's going to be more near the bottom range, like $14 per share or lower than that even. Then I may look at today's price and I may have a totally different interpretation of it and think, no, I'm not going to pay today's price because I think the future growth isn't actually going to be that high. And so I might think it's below that, and therefore I think today is an expensive price. So this whole section here helps me get a really good understanding of that. And so looking at this chart, what I would go and do is read more about the company and the underlying business, and I can do that up above in the company report here, and look at the recent news and updates, and look at the company's share price performance chart, because there's a whole bunch of underlying business developments there. I'll have a read through that and try and build my own thesis around what I think the growth prospects are likely to be. And then I'll come back here and make my own estimates. Now, the very last bit of the future growth section I check on is the future return on equity. And this is just to try and check if the company is expected to have profitable initiatives that it can invest in the future. And this measurement is basically how well the company allocates shareholders' equity into profitable investments. And we can see here that for the analysts who do provide an estimate, they expect the company's return on equity to be about 28% per year. 28% in 3 years' time. And that's really good, right? As a prospective shareholder, I look at this and I go, yeah, okay, it's good to see that they have profitable initiatives to be able to invest in, or they're expected to at least, in 3 years' time. And when I compare this to the industry being like just under 11%, I'm like, okay, sweet, even better. Like this is the 11% right now that the industry is generating, and it's good to see that it's like, okay, well, this is better than the industry average prospect right now. So maybe that's a reason why I might be willing to pay a higher multiple for this stock, because it has better profitability metrics, stuff like that. So that's the whole future growth section of Netflix on Simply Wall Street. And so what I would do next is, if I didn't kind of like the prospects here and I was like, no, I want a better company that's growing earnings and revenue greater than 20%, I could actually have a look at other growth companies in the media industry by clicking this link here, and I would see what other prospects are out there. Like if I'm maybe Netflix is my best opportunity, I can go have a look at these other companies here. Alternatively, say I do like Netflix and I want to keep reading more about it, what I would do next is continue reading the rest of the company report just to get more of an understanding of the company's, how it stacks up in the Simply Wall Street checklist. And then I would go read more about the business in the news and the recent updates section, and just try and get a more qualitative understanding of the business and learn more about it, so that I can make my own judgment on the company's future prospects and what I think it's likely, how much growth it's likely to actually have. So this has been the future growth section. I hope it's been helpful going through this. If you have any questions, please let me know in the comment section below. But I hope this has been helpful, and thank you so much for watching.